welcome back to another episode of Lessons into Blessings podcast. I'm your host, Tari Thomas, and today we are talking about 10 ways to buy your next rental property with little to no money down. Yes, we are already a quarter of the way through the year and time is a-ticking. And whether you currently own your own real estate or not, these strategies will help you to take down your next property in 2024. I am always talking about using what you got to get what you want. And in this episode of Lessons into Blessings, we are going to be talking about leverage. Look, leverage is the way you pick up items with little to no money down, because it's all about leveraging the skills, the assets, the relationships, and other resources that are in your fingertips to walk you into your next property. And these are strategies that I've used, probably over half of these strategies, and I know they will work for you when done right. So make sure that you like, share, and subscribe, and make sure that other people have the opportunity to get these resources at their fingertips. So without further ado, let's jump into our number one strategy. So for the investment strategy number one, it's all about leveraging your primary residence. And so the number one investment strategy is to purchase a new primary residence home and make your own primary residence a rental. Look, if you already own a home, you are ahead of the game. And one of the most common ways to become a real estate investor is by turning your current primary residence into a rental property. This is a strategy I've used, and I've used it because traditional investment property loans require a large down payment. Oftentimes, you can expect a 20 to 25% down payment requirement. In addition, the interest rate on an investment property is generally higher than the rate of your primary residence by possibly a 0.5% or more. So you not only get to pay a lower interest rate, but you can pay a lower down payment, anywhere from 3.5% if you're using an FHA loan to 10% if you're using a Fannie Mae or Freddie Mac product. But this is a huge savings because an investment property is typically 20 to 25% down. In addition, you can use the income that you make from the rent to cover part of the mortgage. Now, things to consider is it will require you to live in the property. Based upon the loan that you take, you will typically have to live in the property at least 1 year. So your lender will also possibly require you to have a signed lease agreement for your current primary residence to ensure that your debt to income ratio is right, and to also make sure that they know that you're moving out and they can provide that to underwriting for close. Now, here's one of the ways that you want to make sure that you're purchasing the property to make sure that you are buying right. You want to make sure that the rents in the area of the new property that you are purchasing covers the principal, interest, taxes, insurance, and the expenses. Now, your income may be able to qualify you, and your income may be able to afford the home. But if you do this investment right and you want to continue to do this investment over and over again, you always want to make sure that when you move out, you have the ability to cover all of the expenses of that home with the rents in the going area. So I want to make sure that you get that. Buy the property right. Now, here's a bonus tip. If you've lived in your current residence more than 2 years, then you can now rent for 2 years after you move out and sell the property within 5 to avoid capital gains taxes. Now, that's huge. With long-term capital gains taxes being about 15% for most people, a gain of equity of, let's say, $100K would have you saving $15K in taxes. This is money that you would typically have to give to Uncle Sam or the government that you get to keep in your pocket and possibly use to invest into your next property. Now, this leads us to strategy number 2. And the next 2 strategies that we're talking about is all about leveraging your home equity. So our number 2 strategy to purchase your next property with little to no money down is to leverage your home equity with a cash out refi. A cash out refinance lets you refinance your mortgage for a higher amount than you actually owe, up to a certain percentage of your property value. Now, this can typically be anywhere from 70 to 80%, but it allows you to take that extra loan amount and pull cash out. In this scenario, the money advanced to you by the cash out refinance can be used to make the down payment on your next investment property. In other words, if you have enough equity in your current home, you may be able to start investing with no money out of your pocket. Even the closing costs can possibly be rolled in. Now, let's use an example. If you bought your house for, let's say, $250K and it's currently worth $400K, you can take up to 80%, which allows you to pull out $80K out of your house. Now, I would only pull out what you need for your investment property. But the advantages to this strategy is it is a no money down solution. Even the cost of the loan can be rolled into the mortgage. And the equity in your home is now being not only utilized to grow appreciation in your primary residence, but it helps you take that equity to utilize to grow appreciation in two places. That is a game changer. You are essentially doubling down and growing your net worth at a faster pace of just sitting just in your primary residence. Now, some things you want to consider. The lender may only allow you to cash out up to 80% of the value in your property. This allows you to not pay any mortgage insurance. The interest rates, however, will all vary based upon the loan to value you borrow up to. So the lower your loan to value, the better your interest rate is going to be. Now, typically, you want to identify the property you want to invest in immediately. Now, this ensures that you are not paying interest on the funds you pulled out without having the rent to cover it. Make sure that the rents from your new investment property, as we talked about in strategy number 1, covers not only the new investment property's principal, interest, tax, and insurance and expenses, but also the difference in the payment that you will have to make on your refinance payment. Now, I typically would only recommend this strategy if your refinance rate is better than your existing rate, because this allows you to take advantage of a lower interest rate. But in the strategy number 2, we'll talk to another strategy I would recommend if the interest rate is a little higher. Now, investment strategy number 3 is to purchase your next property with little or no money down, is to leverage your home equity, but instead of doing a cash out refi, we're going to use a HELOC. Now, a HELOC is a standard home equity loan that can be used to fund a down payment. Using a HELOC is a secure line of credit against your home, and then you draw on it whenever you need cash flow. The reason I like this strategy better than the cash out refinance is, well, you don't have to pull money out of your house. That allows you to be able to finance your down payment with the closing costs of the HELOC. Now, because you don't have to pull out cash in your property, that means you don't have to refinance. Now, this is a benefit if your interest rate is higher than your current interest payment that you're making on your primary residence. This allows you to still borrow the equity against your home without having to refinance at a higher rate, because that could possibly be a disadvantage. So another advantage is you don't pay on the loan until you start using the cash. This allows you more time to find the property you want to invest in before having to incur any interest payments that you're making. Now, HELOCs are usually interest only, so all of the interest payments that you're making can be written off. Talk to your tax advisor about that strategy. And you can use the net income from the investment property rents that you're making to pay off the principal of the HELOC. So, as with any strategy, there are some things you should consider. The HELOC interest rate is usually higher than doing a cash out refinance, so just count the cost. You should always consider the cost to leverage the equity in your home, aka the interest rate at which you are borrowing with. So some things to ask yourself. Does the rent from this investment property that I'm purchasing, will it cover the cost of the HELOC and the property that I'm purchasing? You really want to make sure you do that. And that's just to make sure that the rents that you of the area of the property that you're purchasing covers all of the expenses. When you're in this scenario, it is truly a win-win. A lot of investors will only bank on the future equity, but I want to know that the rents are going to cover those expenses. Now, here is a bonus tip for my savvy investors. Now, if you already accumulated several rental properties and you have a couple investment properties already under your belt, you can actually borrow against the equity in your investment properties with a line of credit. Now, usually regional banks do this strategy, but this is a strategy that I've used myself where I pulled no money out of my pocket. I just leveraged the equity in my investment properties to pick up my next property. So this is something that I want you to check out. And hey, if you need resources for the types of regional banks that do these products, feel free to direct message me. This leads me to investment strategy number 4 to pick up your next property with little to no money down. And that is be a resident and a landlord. Well, we talked about in strategy number 1, the difference is here is buy a multi-unit home, AKA house hack. Your primary residence doesn't have to be a single family home. Multifamily homes is a great way for beginner real estate investors to get started buying properties that generate income at a greater rate than a single family home. When living in one unit, you have the ability to rent out the others. And this is an awesome advantage because the rent payments help to offset your mortgage payments and the other recurring house costs like taxes, insurance, and maintenance. It's also the way you want to be able to take this down is using an affordable financing solution. Now, you can do an FHA loan to get into a property like this for 3.5% of the purchase price. But in 2023, in an effort to improve home affordability, both Fannie Mae and Freddie Mac have slashed its down payment requirements for owner-occupied multifamily 2 to 4 unit properties from 15 to 25% all the way down to 5%. This means you can buy a duplex, triplex, fourplex with just 5% down, live in one unit, and then earn passive income from collecting rents on the other units. I love this strategy. In fact, I'm looking for one myself to take down like this. So things you want to consider is always make sure you buy right. You want to be able to continue to utilize this strategy for as long as you can. So whenever you move out, you want to make sure that the rents can cover the mortgage and all of the other expenses. So make sure that you're not only using your income to qualify, but you want to know that the rents in the going area are going to be able to cover this mortgage in the long run. Awesome. So the only downside to any of these strategies when you put little to no money down is that you will incur private mortgage insurance payment, which is a small price to pay for putting a little to no money down on an investment property. Now, here's a bonus tip for this strategy. If you feel like taking on a multifamily unit is too much, you can also do this same concept with a single family home. You can house hack with a single family home, especially in a home that is larger, like a 4-bedroom or 5-bedroom property. You can treat every room like a unit in a multifamily property and rent out the spaces. This is a strategy that I've used as well, and it helps you also, once again, pay down your mortgage so that you can use that money that you're saving to go invest in your next property. Look, I know I dumped a lot on you with these first 4 strategies, so take your time to review and make sure that you are liking and sharing this information with someone else so that they may be able to get the same advantage that you have right now. Look, there's room for us all. And so we're going to still have 6 strategies to go. We're going to be sharing those strategies over the next couple of weeks. So stay tuned. Until next time, stay blessed.